Welcome to Module 2, Lesson 1 of the ForexDelight Trading Mastery course, focusing on risk management.
The core lesson in this module is the #1 rule of risk management. Never risk more than 2% of your capital on any single trade. The 2% rule serves as your financial safety net. It protects you from catastrophic losses and emotional trading, allowing you to survive losing streaks. By limiting risk, you preserve your capital, ensuring your account stays alive to trade another day. This rule also removes emotion from trading, making each trade less stressful. It is the professional standard that successful traders follow. So what does 2% mean? It is the maximum loss you are willing to accept on any single trade. For a $500 account, 2% risk means a maximum $10 loss per trade. For a $1,000 account, the maximum loss is $20. If you have a $5,000 account, your maximum loss is $100. With a $10,000 account, your maximum loss is $200 per trade. Remember, this 2% is the total risk, including spread, slippage, and your stop loss. Let's look at the math of survival and why 2% lets you survive losing streaks. If you start with a $1,000 balance and risk 2% per trade, after 10 consecutive losses, you will still have $817 remaining. In contrast, if you risk 10% per trade, after just 10 losses, you would be down to $349, nearly 2/3 of your account gone. A critical point is that bigger losses require much bigger gains to recover. For example, a 10% loss requires an 11% gain to break even. If you experience a 50% loss, you would need to achieve a 100% gain just to recover to your original balance. Furthermore, a 75% loss necessitates a 300% gain for recovery. This shows the importance of controlling losses. Here is a simple formula to calculate your 2% risk per trade. To find your maximum risk amount, take your account balance and multiply it by 0.02. For instance, with a $2,000 account, multiply $2,000 by 0.02. This results in a maximum risk per trade of $40. Next, let's review some common mistakes to avoid. Do not make these fatal errors in your trading. Avoid risking more after losses, as this is revenge trading and can kill your account. Also, using 5 to 10% risk will lead to blowing up your account quickly. Never trade without a stop loss. Unlimited risk is a guaranteed path to failure. Do not average down by doubling losing positions, as this compounds losses. Also, always account for spread and slippage, as the real cost is higher than just the stop loss. Remember that 2% is the maximum risk. Risking less is often better, depending on the situation. During the learning phase, risk only 0.5 to 1% while you are mastering your strategy. For uncertain setups, where you have lower confidence, reduce your risk to 1%. In periods of high volatility or wild markets, it is wise to reduce your risk to between 1 and 1.5%. If you have multiple positions open, be aware of your total exposure. For example, 3 trades at 2% each means a 6% total risk. Finally, reduce your risk to 1% after 3 consecutive losses to protect your capital. Let's look at a case study comparing 2 traders with different risk management approaches. Trader A, risking 2%, started with $5,000. After 15 losses, their account was down 21%, still trading with confidence, and the account survived. Trader B, risking 10%, started with the same $5,000. After 15 losses, they were down 79% to $1,028. The account was nearly dead, and the trader was emotionally destroyed. Adopting a professional mindset is key to consistent success in trading. Remember, capital preservation always comes before profit. One bad trade should never destroy your account. Losing trades are inevitable, so protect yourself. Your first job is to not lose money. Your second job is to make money. Amateurs focus on profit, but professionals focus on risk management. Here is your implementation checklist and action plan to start today. First, calculate your 2% risk amount based on your account balance. Then, set this amount as your maximum risk in your trading journal. Crucially, never exceed this amount per trade. Finally, write down your maximum risk amount on a sticky note and keep it visible as a constant reminder. Add a step to your checklist. Review your maximum risk amount before every single trade. Also, track your risk percentage in your trading journal for every trade you make. To summarize the key takeaways, Never risk more than 2%. This allows you to survive 20 or more consecutive losses. Remember, big losses require huge gains to recover. Always protect your capital first. This rule is non-negotiable for long-term survival.